Welcome back to Finance Uncut. On today's episode, what is a wealth cycle and how can you profit from it just like me? So, what is a wealth cycle? Well, before we get to that, let me tell you what it isn't. It isn't the Big Mac index. So when I do a lot of presentations and talk about wealth cycles, a lot of people get confused and think I'm talking about the Big Mac index and talking about exchange rates and currencies and whatnot. It's got nothing to do with that. So before we cut to a clip to have a look at just what is a wealth cycle, once the video is done, we'll come back and we'll go into the Incrementum In Gold We Trust report. We'll have a look at a chart deck from 2020 where I'll talk about wealth cycles and how I've been playing it. And then we'll look at their 2021 chart deck, which came out last week or the week before. And we'll go through that and you'll see some of the opportunities for wealth cycles. And then at the end of that, I will share my experience and how I basically turned $68,000 into about $750,000 using wealth cycles and how I'm doing it again, because I believe that we've got an opportunity for this wealth cycle to happen all over again right now. So stay tuned to the end and I'll share that. In the meantime, let's cut to a clip and see what wealth cycles are all about.
If you can see that, then you can sell the undervalued asset class, sell the overvalued asset class, and buy the undervalued asset class. And it's like busting these cycles apart and pasting the next wave onto the end of the last one. And it is a road to true wealth. I'll show you that in a moment. Now, some of the examples I'm going to give here, I understand that nobody can catch the exact top of anything, and that these are much longer time frames than most people's lifetime even. However, I just want to show you the immense power of this, the types of gains that can be made. This is in the 1920s. This is a upper middle class home, nice like 4-bedroom, large home with a swimming pool in the backyard and a decent amount of land. And that sold for about $3,000 in the 1920s. And gold was $20 an ounce back then. So it would have cost $3,000 or 150 ounces of gold. Conversely, if you had sold the home, you could have gotten 150 ounces of gold for it. And then in the 30s, and this is just a few years, I mean, this could have been 1928 and this is 1932. So it's not very long that you had to wait. The house fell to $2,000. Gold was now $35 an ounce. So that meant that this house only cost 60 ounces of gold. If you had sold this house for 150 and bought gold and then repurchased, you could have gotten 2.5 times the amount of real estate in just those few years. Then in 1970, that house was now $30,000, but gold was still $35 an ounce. So it cost 850 ounces of gold. So if you had bought this home, the 2.5 times more real estate in the 30s, and then in the 70s sold for when it was $30,000, 850 ounces of gold, you would have received 2,125 ounces of gold. Then just a decade later, because of rampant inflation, the house was now $60,000. But gold became free trading in 1971, and it went from $35 an ounce up to 850. So that house was now worth 70 ounces of gold. It went down from 850 down to 70 during that period of time. So if you repurchased real estate with your 2,125 ounces worth of gold, you would have now gotten 30 of the same type of home that you sold in 1920, you would now own 30 of them. And then in the year 2000, gold bottomed at $250. That house was now worth $200,000. Same house. The house hasn't changed. It's $200,000. But gold had gone down, so it now cost 800 ounces. And so if you sold the house in the year 2000, you would have received 24,000 ounces of gold. Then in 2011, gold hit $1,925 an ounce. And the house was now worth $300,000, but it was only worth 150 ounces of gold. So you could have, in 2011, bought 160 homes with the proceeds from taking this one home and just going back and forth to different asset classes. 160 homes. However, this cycle isn't done yet. This is, you'll see later in the Dow Gold ratio, gold's price went from 35 to 200, from 71 to 74, and then it went back to 100 to late 76, and then it took off and went to 850. We're basically in that mid-cycle correction now, and it's pretty much over with. And so now we get to see the fireworks of the end of this cycle. I don't know when the end is going to be. I don't know if it's going to be 2019, 2020, 2021, 22, could be 2023. But what I'm fairly confident in is that house is measured. It could be $30,000 measured in U.S. dollars if we're still fighting deflation and we don't have any big inflation. But it could also be $3 million if the Federal Reserve is fighting deflation. They just print and print and print, and it keeps on going into real estate and the stock market. But either way, it's measured in gold. It's probably going to be somewhere around 50 ounces of gold. And if it hits 50 ounces of gold, that means you could buy 480 homes that are the same home that you started here with in the 20s. It's just the same investment, just jumping from different asset classes. Now, the gold that you received here makes you worth, let me see, I think that was about $30 million worth of gold. If you hang on to it and buy this real estate, this is about $1 billion worth of real estate. So you've gone from $3,000 to $1 billion. That's, this sounds absurd, but these are just numbers. This is an exercise on what is a wealth cycle and how big is its power. So this is the maximum power. You'd have to have a lot of luck, but you can catch quite a bit of this wave just by looking at numbers and making the right decisions.
So before we have a look at the 2021 In Gold We Trust report, I want to have a look at the chart book from last year's In Gold We Trust report and see if we can find some things that tell us that we're about to enter a new wealth cycle. So right here with the Dow Gold ratio, I've said in previous videos that I started buying gold and silver again in 2018. And then the beginning of last year, I stopped buying gold altogether and just loaded up on silver. And one of the reasons was looking at the Dow Gold ratio. So, we know that the stock market is severely overvalued, that it's not running on any fundamentals. And with, the inflation that is, or the CPI increases that I expect over the coming years, the amount of new currency units, either base or broad, rising, yield curve control, negative real rates, I think are so bullish for gold. So I think gold and silver are cheap at these prices, and the stock market is overvalued at these prices. So once again, you can look at this chart and go back, really to the formation of the Fed, and you can see that gold was low, stocks were high, then gold was high, stocks were low, and then so forth. You can see the changes. And so just on this chart, I think buying gold and silver around these prices, just sit on it for a little bit, and I think I will then trade some of that gold and silver in for more stock. And here we've got commodities versus the Dow Jones ratio. And once again, last year I was doing presentations, and even in my earlier videos, you go right back to when I began this channel last year, I was saying that commodities are the play that I'm getting into, that they're really the only asset that I saw that were cheap. I'm a value investor. I like buying things that are on sale. And so when I look at this chart, to me, commodities have never been this cheap. And the gold S&P 500 ratio, you can see that it peaked in the second half of 2011. So that was around the time that you should have been selling your gold and silver and moving into risk assets like the S&P 500 and riding that all the way down. Now you can see late 2018, it looks like this ratio has bottomed and is moving upward ever so slightly. But yeah, this is another indicator for me that that the stock market is now overvalued and that gold and silver is undervalued in comparison. And I love this chart of the S&P 500 gold ratio. So if you go back 1970, when we were in a dollar bearish, high inflationary environment, you didn't want to own the S&P 500 then. You wanted to own gold and silver. We know what gold and silver did during that 1970s period. But by 1980s, when Volcker jacked up interest rates to squash inflation, we also had the peak of gold and silver. But then we went on like a 20-year bull market in the stock market. So that's where you wanted to move out of your gold and silver, move into risk assets like the S&P 500, ride that wave up. Then once again, you look at 2000, around that period, the stock market became severely overvalued, while at the same time gold and silver had just plummeted. And so then you switch right through to the GFC to 2011 period is where there was a bull market for gold again. So the dollar was bearish and inflation wasn't as high as the 70s, but it was a great time for gold and silver during that period. And then quantitative easing kicked in, more base money into the financial system, and gold and silver both peaked in 2011, bottomed out for gold in 2016, and we've had this run up in the stock market since then. And so you wanted to be in risk assets over the last decade. However, for me, 2018 is when I started jumping back into gold and silver. I started selling my risk assets, and it's so far it's working out quite well. Some may say I've left some profits on the table in the stock market. So be it. And when we look at the gold silver ratio, anytime it really gets above 80, that's where I personally just buy silver. I don't buy any gold. I just buy all silver at that point. And early last year, we saw the gold silver ratio almost hit 120, and early last year, that's where I basically just stopped buying almost any other asset. The only asset I was buying at the beginning of last year was silver, and getting as much of my hands on it as I possibly could. Now I've discussed in other videos that Keith Neumeyer from what's his mining company? Anyway, you guys will know it. Write it in the comments below. Keith Neumeyer says that they're mining for every 1 ounce of gold, they're mining about 7 ounces of silver. So the mining ratio, what's actually coming out of the ground, is more like 7 to 1, not 80 to 1, 70 to 1, 60 to 1. So for me, silver is still undervalued just on this metric alone. Yeah, so that's Keith Neumeyer from First Majestic. I just remembered it, just popped into my head. So the silver to S&P 500 ratio, look, it's, once again, I've said it before, I think gold and silver has been severely undervalued compared to the stock market for the last couple of years. and silver to the NASDAQ, the QQQ ratio. For the last decade, you wanted to be in stocks. You wanted to be in tech growth momentum type stocks. Value has not performed that well. However, I think that's going to change. I think it's already started to change, and we're seeing that the tech growth stocks that don't have, profits and trading on high multiples are now coming off the boil, and we're seeing actually some rise in the share price in many value plays. But once again, silver severely undervalued on this metric as well. Now, let's have a look at the In Gold We Trust report from this year that just came out last week. So last week I did a video entitled Inflation Could Hit 20%. And in that video, I argued that we've crossed the Rubicon. We've entered a new domain. We have gone from a monetary dominance to a fiscal dominance, where we've got essentially MMT. And I think that's going to ramp right up as we move forward. But I'm not going to talk about that. If you want, go back and watch that video, and you'll see why I believe that we've gone from this monetary dominance, where it's all base money from the central banks, to now it's going to be fiscal dominance. And I'm not the only one saying that. Many people much more successful and smarter than me that is saying this. I mean, even the fundamentals are bullish for gold, silver, and other commodities. We're going to have more fiscal dominance moving forward. This chart just shows exactly the state of the budget, debt, deficit, and get ready, because we're going to get a Green New Deal. We're going to get all these new social programs, UBI, I believe, and the whole works. And that's going to be super inflationary, because you know what? People don't read history books. People don't read sound economic books or monetary history. And we're making the same mistakes over and over and over again. Another fundamental issue is that Russia are now dumping all their US dollar treasury reserves. And who's going to finance all this fiscal spending, these huge debts? Governments issue these bonds. Who's going to buy them at these kind of interest rates, with the inflation that everyone is now worried about? It's going to be central banks, and the consequences of central banks monetizing the debt is super inflationary. I now understand why Dr. Michael Burry and Professor Richard Werner are calling for hyperinflation. They've gone beyond the 20% inflation, gone beyond the 10% inflation or the stagflation. They've jumped straight into the hyperinflation bandwagon. So just an update from the 2020 chart deck to this year. You can see the green circle or oval on the right-hand side. You can see that March we had this big sharp jump up in the gold S&P ratio, and that's because we had that market crash of 32, 34%, whatever it was. But then since then we've had just an absolute crazy amount of speculation and debt being poured into the stock market. We've had a huge stock market rally. So I've definitely taken some profits. The profits that I hadn't taken before, I've definitely taken more profits off the table there. And in terms of real estate, so I'll come to that in a sec, actually. So you can see that gold has kind of gone sideways. It actually went down. It's come back up a bit since last year, since basically hitting its highs in August last year. But once again, for me, looking at the wealth cycle, stocks overvalued, gold, silver undervalued. Also looking at an updated gold and S&P 500 ratio chart, you can see that we were heading up towards that mean. So gold was going up, gold since going down. So gold looks cheap compared to the S&P 500. Inflation and the boy who cried wolf. Stan Druckenmiller. My own sort of central case is that for the first time in a long time, I'm actually worried about inflation. So when we look at the monetary growth, so the M2 currency supply, it is far bigger than the inflationary 1970s period. Now, if you've been following this channel, you'll know that lately I've been sharing a lot of work that Lyn Alden has done, comparing now more to the 1940s than the 1970s. So I think the 1940s have probably got more of a correlation or similarity to what's happening now. So, but folks, you create so much broad currency. At the same time, you're shutting and locking down economies, shutting down production, less goods and services, small businesses going under. What's the outcome? It's really economics 101. M2 per capita and CPI are highly correlated. So, yep, I think we're going to see significant CPI in the years ahead. I love this chart. Commodities and inflation expectations are very nicely correlated, as you can see. So once again, keep an eye on the inflation expectations, and that will give you a guide to where commodity prices are going. And then looking at the commodity index and S&P 500 ratio, once again, we've got the everything bubble except for commodities. So commodities still cheap in comparison to other assets, in particular the stock market. So go back and watch. If you haven't watched my video that I did last week, inflation could hit 20%, go watch it. Have a look at the Google trends for modern monetary theory. Stephanie Kelton's book, The Deficit Myth, has she's written that really, really well. I've read most of it, and people that don't have a sound understanding or foundation of economics will read that and go, "Oh yeah, MMT makes sense. Let's do it. Why are we following all these other economic theories?" And then the question is, will Powell and Yellen test the MMT in the US? I think they already are. And I think it's only going to increase from here. So looking at inflation rates, so if we believe that we're going into rising inflation, then look at what doesn't perform. Shares don't perform, bonds don't perform. Mining shares do well, precious metals exceptionally well, and raw materials. So this is why I've been banging my head against the table. Real commodities, precious metals, mining shares, exploration stocks, and biotechs. That's pretty much my portfolio right there, and some real estate. I've shared in other videos that the stock market doesn't perform when we have inflationary environments. I've shared the 1970s before. I shared the crash in the stock market in 73, 74. So you get chewed away with if you want to invest in stocks in a highly inflationary environment, expect to actually lose. So silver has shown relative strength versus gold, but I think it's still got a long way to go. I think silver and gold, even in this bull market, I think silver on a percentage basis will outperform gold. So the question is, will silver miners start outperforming tech stocks? Well, I certainly hope so, because I am heavily invested in gold and silver miners and explorers. So I was chatting to someone the other day about silver, and saying that they believe we're not going to see silver under $20 again, not for a while. He believes that silver definitely bottomed in the crash in March last year, and we've seen a terrific run up. However, even with that run up, when you compare it to the S&P 500, it's still relatively cheap, and I think silver's got a lot more run. Well, I think the bull market's only just beginning. So I look, silver can chop around a little bit, come back a little bit. I think my buddy might have a point that we're not going to see silver below $20 again anytime soon. So but once again, relative to stocks, silver's still dirt cheap. So check out Russia's gold reserves as a percentage of GDP from 2000 to 2020. They've just bought everything, and Italy, Germany, France, Netherlands. Seems like the US have bought some more. Unfortunately for us Aussies, our Reserve Bank thought it would be wise to sell our gold when it was really, really cheap and buy US Treasuries because, hey, it provides some yield. Yep. Our Reserve Bank of Australia is very, very smart. Yeah, and you can see that gold reserves have risen sharply in the last 12 months. Banks are now due to Basel III. Central banks holding it. It's a tier 1 asset now. So expect a lot of demand. So I've shared in other videos, kind of if we were to reset gold and silver, what the price in gold and silver would be, and look, a lot of you think that's airy fairy, stuff in the clouds kind of thing. But at the end of the day, governments and central banks might be forced to go back to sound money again. If they were to go back to even a 40% gold coverage, then to avoid an inflationary and deflationary depression, you need to get the price right, resetting the price of gold, and it would need to be about $24,000. I actually think this is a bit low. From I'm not sure when Ronnie Stoffele did this, collected this data, but I believe that the gold price would need to be higher than even 24,000 to avoid that inflationary or deflationary depression if we were to go back to a gold standard of some sort. And having a look at the commodities to Dow Jones ratio, an update. So this is the latest one. Once again, commodities are still undervalued, measured against the Dow. So whether you're measuring gold, silver, or commodities against the Dow, against the NASDAQ or the S&P 500, they are still cheap, still undervalued, and versus real estate as well, I believe. So before we get to my story about how I've used wealth cycles, check out this chart. So these are the dates of the biggest declines in the S&P 500. Now have a look at gold in comparison during that time. So only once has gold gone down more than the S&P 500, and that was between November 1980 and August 1982. Now, gold also did fall between July 98 and August 98. However, it only fell 5% compared to 19% on the S&P 500. Otherwise, all the other times, gold has actually increased. Gold has actually done exceptionally well. So in these times, had you moved into gold and then sold gold, moved back into the S&P 500, you just would have done so well. And then looking at silver, silver actually gained during 76 and 78, and then down in 07, 09. It also underperformed in that 1980-82 period like gold did against the S&P 500. So basically everything went down then. But even though silver fell in all those other times, so in orange, it still fell less than the S&P 500. So you'd still benefit with the wealth cycles if you owned, silver during those periods of time, because even though silver fell, it didn't fall as much as the S&P 500. And so it's all about going from one asset class to another in being able to buy more of the next asset class, and then vice versa. So anyway, that's what I love. So let's have a look at how I've used wealth cycles. So let me share my experience with wealth cycles. So I've shared this in previous videos. In 2008-09, I bought silver. I bought silver at $10, $12, $13, $14, and $16. I just bought it in different tranches. It wasn't exactly $10 on the spot. It might have been $10, $23, whatever. All up, I bought about $68,000 worth of silver, and the average buy price that I've worked out was around the $13 mark. In early 2011, while I was sitting in my office in Ipswich, which is west of Brisbane here in Queensland, Australia. A Scottish man came to my office and wanted to sell me cheap US cash flow real estate in Detroit. And the houses he was showing me and the numbers on it, were just incredible. These houses that were dirt cheap, paying, 25, 30% gross rental yields and, huge net yields. And I was like, holy smoke, I've never seen returns like that in real estate before. Coming from Australia, we've got very expensive real estate. You just don't see those type of yields. But I had my doubts because I knew Detroit had a lot of issues back then. And I met a colleague of mine in my industry who had already started buying US cash flow real estate. And he had made a bunch of mistakes, bought in the wrong areas, had issues with property managers, and you name it. So I got on him very quickly. He shared his story with me. And next thing I know, in 2011, I started selling my silver. And I started selling it at $43, $44, and $46. Now that $46 was actually on the way down, so it went up to $49. I sold it on the way down. I wasn't selling that part on the way up. And so, look, I got a bit lucky. Had that Scottish man not come, I probably might have held my silver, because at this stage I didn't really know what wealth cycles were. And so there's a bit of luck, bit of good timing. So I sold my silver for approximately $232,000. At the time, I then sent these funds over to the US at an exchange rate of $1.04. So the Aussie dollar was above parity. So it gave me about 241,000 US dollars, where I bought 6 cheap homes in Atlanta and Memphis. With my first townhome I bought in Atlanta, cost me $29,000 for a 3-bed, 2-bathroom townhome. You can't even buy a bit of a crummy second-hand car here in Australia for that. Now, all these properties are worth approximately about $115,000 in Atlanta and about $75,000 in Memphis. Now, I have been, and I've shared this before, I have been selling these properties into this bull market. I've got the rest of my Atlanta properties on the market at the moment. Memphis ones I'll probably hold on to. I like to hold on to something. So I turned $68,000 in 08-09 to assets worth $788,892 in Aussie dollar terms today, using these wealth cycles. Now, I stumbled across wealth cycles. So yeah, I'm doing it all over again. I stumbled into it. I'm doing it all over again. As I said, I've been selling these homes into this bull market. As our dollar has fallen, I brought a lot of the funds back to Australia. I've been acquiring silver and gold since 2018. And as I said, at the beginning of 2020, when the gold-silver ratio was above 100, I was only buying silver at between $12 and $16. So in March last year, I really backed the truck up and started loading up on silver, especially when it fell in March last year. So yeah, I've been buying the physical gold, silver since then, gold and silver mining and exploration stocks. I've had success with that before, and I've shared that. I love this sector, and you can really get huge leverage, asymmetrical gains on the mining and silver exploration stocks. But there is more risk with that as well, because not all of them do well. I've been buying copper, zinc, lead, and other commodity stocks for this bull market run in this inflationary environment that I believe we're entering. So people always ask me, Steve, at what price will you sell your gold and silver for? Now, I don't sell at a price. Or should I say, at least I don't measure the price of gold and silver in dollar terms, but I measure them in other assets. How much real estate can I buy? How much of the stock market can I buy? How many private businesses can I buy? And I bought, how many private businesses have I accumulated? 1, 2, 3, 4 businesses I've added and accumulated over the years. So, so I'm using wealth cycles again. I think we're heading into a commodity super cycle, and I think real estate, but the stock market in particular, and bonds. I've said this before. Bonds are the biggest bubble I've ever seen. I think they're in for some tough times, and even if they don't go down, even if they don't crash. Now, I think there's a good chance that they do, but let's say they don't. I just think gold and silver and commodities are going to outperform so much that even using that, the wealth cycle. So I'll just be able to buy so much more stocks, so much more real estate, etc., etc. So anyway, that's what I think. That's how I'm playing it. What do you guys think? Let me know in your thoughts and opinions in the comments below. Don't forget to hit that like button and subscribe if you haven't yet. Hit that notification bell, and I'll see you again on another episode of Finance Uncut.